Hi, I'm Tom Mihawk, and welcome to Stocks Basics. This is part of a series of videos that are shortened from earlier ones that I've done. The one I just completed was called Investment Basics. It's about 15 minutes. I think the investment fundamentals video that I did was 3 videos. This was only one. This one will be, maybe 10 minutes and only one. And it's designed for my graduate students, my undergraduates, my non-degree program students, and others that want to learn about stocks. And in a fast way, I will also include the slides, if I can, also include the slides with the notes. So you'll have the hard copies, people to download them, print them, take notes, read them, just in case also I don't read everything on the slide in the video. So here we go. What are stocks? Stocks represent partial ownership of a company, equity. You own a part of the company. You have the right to vote on shareholder issues. You have the right to receive dividends. You have the right to sell the equity in the future and make a gain or potentially a loss. It's a residual interest, meaning value accrues to the equity after others that have claims ahead of you, such as employee payroll, trade creditors, banks, things like that. It has the lowest rights in the event of a bankruptcy. Stockholders have the lowest rights in the event of a bankruptcy. You have a residual claim, but for that you get a higher return than the ones higher than you. Like employee payroll, they just get paid. Trade creditors get paid lower amount in terms of returns. The greater returns of stocks are accompanied by greater risk. We talked about in the investment basics video that risk and return are related. If you find an asset with a high return, chances are it's riskier. Now, it doesn't mean that if you find a risky asset that its returns are greater. It could have high risk and crappy returns, and that's not good. But generally speaking, good assets to invest in that have high returns are generally riskier. They have greater volatility. Companies issue stock to grow, provide liquidity for early investors and founders, people who started the company so they can earn money for their efforts. But there's no commitment to repay stock purchasers. You make an investment, you may get your money back, you may not. Now, the overwhelming likelihood is you will. And if you are smart and you learn and watch videos like this, you'll figure out ways to buy stocks and you'll talk to people, read blogs, listen to podcasts. You'll find companies that will do well over time. But you get a residual claim on the assets. Now, how does my wealth grow? From the increase in share prices. The current value of the stock less your purchase price is called a capital gain. But what you want is you want to buy shares that grow in value. And dividends are paid out of earnings, or in the corporate or accounting sense, net income. Dividends generally increase over time. They're not guaranteed. Companies rarely reduce them. It's a negative sign when companies reduce dividends. So they pay them generally, and they generally increase them. The companies that most typically pay dividends are older, larger, more stable, and in generally more stable industries. This is a copy of the cover of the Yale Endowment newsletter and a copy of the page that show their returns over fiscal years. Notice that it's small, but the return in 2018 was 12.3%. 11.3 in 2017, 20% in 2014. This endowment was run until maybe this time last year when he passed by David Swensen. David Swensen pioneered a program for endowments, and endowments are the money invested by universities to pay for operating expenses and along with tuition payments to pay for running the university. Because of the way they invest and how they reinvest back in the university, they get preferential tax treatment. But David Swensen pioneered a program some have called endowment style investing, and he's written about it, and I'm going to talk about him in just a few moments in this video. Swensen says have an equity bias. Even modest return differentials operating over long periods of time translate into huge wealth advantages. Just like I said in the investment basics video just earlier, that 0.5% a year difference over 40 years is a huge difference. When you look at calculating that on your calculator, whatever one you use. It's a huge difference. Getting 10% a year difference to your benefit is hard. A 0.5% a year is not as hard. Diversify. Diversification improves portfolio characteristics by allowing investors to achieve higher returns for the same level of risk. And be aware of taxes. Keep your taxes down when you can. Don't cause tax events, negative tax events, when you can help it. And also, one thing not mentioned here, but you should also try to keep your fees down in your investments. Try to invest in assets that have lower related fees. Why are equities the best investment over others? Well, here's why. The one on the left is put together by Roger Ibbotson, the one on the right by Jeremy Siegel. They both show that stocks out-return other asset classes over the long period, over the long term. Notice that on the left, Roger Ibbotson shows small stocks at 11.8%, large at 10%. This is from 1926 until 2015, 16, something like that. And that on the right, Jeremy Siegel shows that since from 1802 until I think it's 2012, stocks have returned 6.6% and bonds 3.6%. They have a long history of greater returns than other asset classes, which is why you should look in your investing for longer time frames and invest for the long term when you can. Large stocks, 10% compounded annually for the period 1926 to 2018, 4.5% greater than bonds, according to Roger Ibbotson. 6.6% annualized return from 1802 to 2012, 3% greater than bonds, according to Jeremy Siegel. And the sources from the charts that we just saw. Types of stocks. Common stocks are the most typical form. If the company has only one type, it's probably common. The highest return possibility because it has the least amount of claimants, the lowest in terms of order. When there's a bankruptcy, they have the lowest claim on assets. They typically have some form of voting rights, might get dividends if they're offered, but they're not guaranteed. Preferred stocks have guaranteed dividends, and if they're not paid, they accrue. If you don't get them this year, you'll get this year's and last year's in the next year. Voting rights may vary. They may be callable, meaning the company can ask for them back. It's a superior position in the event of a bankruptcy to common stocks, which means, as you know probably now, you get a lower return. And classes of stocks, A, B, Ford Motor Company, I think, has like up to G. These classes of stocks have different voting rights, different superiority. The Ford Motor Company has various various stock classes because they have family members that have a certain class. Nobody else has that. Public shareholders have that class. Other investors have a different class. Public investors have another class. And so they've built these various stock classes that have various characteristics. Most companies have common. Some have preferred. Older companies, more mature, like Ford, may have these multiple classes. Now, evaluating relative prices. In the investment basics video that we did, we talked about how to value a company, why some have for the same dollar of earnings per share, higher share prices. Two measures, two ways of looking at evaluating relative prices are price to earnings ratio and price to book. Price to earnings means the current stock price divided by the earnings per share. Earnings per share meaning the net income per the number of divided by the number of shares outstanding. It's a measure on a per share basis of how much money the company's made. What you find is that companies that are growing faster have higher price earnings ratios because people will pay more for greater earnings. The idea that over time earnings are related to share prices. Faster growers produce faster share price gains. Price to book is another one. The book value of a company is just assets less its liabilities. It's a little bit of an accounting term, but you can look that up online. These days, all this information is available for any company online, or virtually any company online, certainly public ones, okay? How can you learn about stocks? Well, read about them. Wall Street Journal, New York Times, Bloomberg, Yahoo Finance, blogs, podcasts. There are stories and charts and videos about stocks all the time now. Used to be, it was a huge deal when the web was new, which maybe sounds like back in the Stone Ages, right? But when the web was new, getting stock prices was a big deal. It was not always easy to do. Well, now it's available everywhere. It's just regular news. And companies that you know well, like Apple, Facebook, and Netflix, Google, these stock prices, people see news about this like they do about Hollywood movie stars or, sports teams or whatever. It's just something that people follow. Take an interest in the companies that make the products that and services you like to use. And follow simple things about these companies, basics like what are their sales? What are their earnings, meaning their net income? What's their competitive situation like? What's the new iPhone like? Is it good? People like it? Do they not like it? How's the Apple Watch working? People buying it? Follow these things. We talked a little bit in the investments basics video about alpha and beta. Remember, alpha is the return in excess of the market return or the expected return. Beta is the market return. It's the return of the market. It goes up, goes the same, goes down, it goes the same. We don't want to pay for beta, but we will pay for alpha when we produce a return that exceeds the market return. Fundamental analysis means looking at the company's income statement, balance sheet, its financial statements to determine its value, and in particular, its intrinsic value. That's the value that may differ from the market price. You make a calculation yourself based on these financial statements and determine if it's different from the market price. Technical analysis has to do with looking at charts and making extrapolations about what the future will be, or looking at the past and determining how the stock might behave relative to what the charts have done in the past. You can buy and sell stocks online, in person, by phone, through banks, brokerage firms, mutual fund companies. There's a spectrum of costs. Full service advisors, for example, might have higher fees. Discount brokers, low and getting lower. Some are free now through Schwab, Fidelity, Vanguard, for example. And summarizing, how should I invest? This is in our investments basics video, but it's worth saying again. Have a bias for stocks. Own more stocks than anything else if you have a long term to invest. Because stocks, we know, for the long term produce returns greater than any other asset class by a significant margin. Use diversification to reduce risk, increasing returns for the same risk or lowering risk for the same returns. Be aware of taxes. Keep taxes down when you can choose to do that. Keep your fees and your costs low. Have a bias for index funds or passive management, since most active managers manage funds that charge more than index funds do. They generally, on average, don't beat their indices. Not in the recent last 10, 15 years. That may change in the future. And even still, some active funds and investments do beat the market. And if it's consistent and exceptional, use them. It's not like an ethical or moral issue about passive or index investing. It's just, in general, lower fees mean better net returns. But if you can find something that produces higher gross returns and including the fee, a higher net return, use it. And review your performance regularly. Make changes, rebalance as you need to. Remember, 0.5% more for 40 years is a huge difference. Getting 10% more in 1 year is hard. But getting 0.5% more is not so hard. You can do that by reviewing your investments, making some small changes. 0.5% for 40 years is a huge difference. This was Stocks Basics. I'm Tom Mihawk. Stay with me for our next video on Bonds Basics.